Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be talking about what are bonds, should you invest in stocks or bonds, and how to plan out your asset allocation. Bonds are a fundamental part of investing, although they are definitely less exciting than stocks. This is the third chapter of my Millennial Investing guide, so check out my last video where I broke down the basics of investing in stocks. I'll be comparing stocks and bonds, so if you don't have a solid understanding of stocks, click the pop-up at the top right to watch that video first. So with that, let's jump into the world of bonds. A bond is a type of debt security, whereas stocks are an equity security. Remember, a stock represents a unit of ownership of a company. So when you buy a stock, you own a tiny slice of that company. The more valuable the company, the more valuable the stock. A bond, however, represents a debt that a company owes to you. When you buy a bond from a company, you do not own a part of that company. Instead, you are lending money to them and they promise to pay you back in full plus interest. The bond is an agreement of how much money you're lending them today, how long it will take for them to pay you back, and how much interest you could charge them for the loan. Bonds are a way for a corporation or a government to quickly raise a lot of cash to finance a project. Let's say that the provincial government of Ontario needs to raise $100 million to build a new highway. An easy way to raise these funds is to issue a bunch of bonds to the population. As an investor, I can buy $10,000 worth of these provincial bonds at a maturity rate of say 10 years and a coupon rate of 3%. The coupon rate is the interest rate that the Ontario government will pay me for this loan. So I'm giving the Ontario government $10,000 today and they will pay me back in full in 10 years plus an interest or coupon rate of 3%. That means that the Ontario government will pay me 3% or $300 worth of interest each and every year. We call bonds fixed income investments because we are guaranteed to get this 3% of income every single year, as long as the issuer, in this case the provincial government, doesn't default on the loan. If I buy and hold onto this bond for the full term, 10 years, I'm essentially acting like a bank, lending money out to customers and charging them interest for these loans. I know exactly how much money I will receive at the end of the term and exactly how much interest I will earn throughout these 10 years. But I don't have to hold on to this bond. I can sell this bond to someone else the same way you buy and sell the stock. In the stock market, when you buy and sell stocks, you are transferring units of ownership of a company. But with bonds, you are transferring units of debt. And just like with stock trading, the price of a bond is always changing. It depends on how much someone else is willing to buy it for. There are a few things that determine the value of a bond: the credit quality, the overnight interest rate, and the state of the stock market. The credit quality is kind of like a credit score, but for an organization. A high credit rating means that the issuer, the one taking on the debt, has a good reputation and they are almost certain to pay back the debt. The highest credit quality bonds are called investment grade. And these are usually issued by the government, either at the federal or provincial level, or by large established companies like Enbridge. These are like the blue chip stocks of the bond market. Low risk, but reliable and modest returns. It is extremely unlikely that the government of Canada will go bankrupt and default on your loan. And since these bonds have such low risk, they also have low returns. They'll only pay you an interest rate around 2%. But if a smaller and newer company needs to raise money, they haven't been around long enough to build a solid credit rating. And so they have to offer a much higher interest rate to entice investors. Loaning money to these smaller companies involves greater risk, since there's a good chance that these companies won't be able to pay back the loan in 10 years. And so, when these companies issue bonds, they have to offer a higher coupon rate, usually around 4%, to make up for this extra risk. These are called high yield or junk bonds. They're kind of like the penny stocks of the bond market. High risk, but higher potential returns. Interest rates also affect the value of a bond. The value of a bond varies inversely with the overnight interest rate. If interest rates go up, the value of the bond goes down. And if interest rates go down, the value of the bond goes up. The overnight interest rate is set by the Bank of Canada and it establishes the cost of borrowing money. All major Canadian banks and financial institutions will try to match this overnight interest rate. Let's say that the current Canadian overnight rate is 2%. And you bought a 10-year government bond in 2019 that offers a 2% coupon rate to match. Let's say 1 year later, the Bank of Canada increases the overnight interest rate to 3%. And now in 2020, all government bonds will be issued with a 3% coupon rate. Your bond that you bought last year is locked in at a 2% coupon rate. So you're gonna have a hard time trying to sell it to someone. Who would buy a $10,000 bond earning them 2% when they could just go out and buy a brand new government bond earning them 3%? Your 2% government bond is worth less. So if you want to sell it, you're gonna have to sell it at a discounted price. And so you'll be losing money. Of course, you don't have to sell this bond. You could hold on to this bond for the 10 years and collect that 2% of interest along the way. On the other hand, if next year in 2021, the government drops the overnight interest rate to 1%, now your 2% bond is worth much more than all of the brand new bonds being issued this year. Everyone would rather buy a 2% bond from you rather than a brand new 1% bond from the government. And so you can sell that bond at a higher price and make yourself a nice profit. The final factor that affects bond prices is the state of the stock market. And this is one of the main reasons why people buy bonds. The value of bonds varies inversely with the stock market. When the stock market is booming, this is called a bull market, and everybody wants to jump in and buy stocks to take advantage of those great dividends and capital gains. No one really wants to buy bonds, and so the value of bonds stays relatively flat or even goes down. But when the stock market plummets in a bear market and people lose 20% of their investments over the course of a single week, like we saw in the 2008 recession, bond prices actually shoot up. People are really panicked and they crave the security and reliable income that bonds offer. And so they'll sell a lot of their stocks and invest heavily in bonds. The demand for these bonds shoot up and so do their prices. That's the true power of owning bonds. Bonds are boring and secure and they only pay you a small amount of income every year. But during a recession, their value goes way up while stocks are free falling. Let's say in 2008, you had all of your money tied up in US stocks. When the housing market collapsed, you probably lost 20, 30, even 40% of your money if you sold those stocks. Of course, if you were calm and you didn't sell your stocks, you would have recovered within a year or two. But what if you were retiring in 2008 and you needed to start withdrawing that money to live? You would have lost up to 40% of your retirement fund at that moment. Instead, if you had half your money in stocks and half your money in bonds, your bonds would have protected you from the stock market collapse. Your stocks may have dropped 40%, but your bonds would have skyrocketed in value. Even better, you could have sold your bonds at that peak value and then bought a bunch of stocks at those rock bottom prices. So you may be asking yourself, should I invest in stocks or should I invest in bonds? The answer is both. It is important to have both stocks and bonds in your portfolio. The real question is how much of my portfolio should be in stocks and how much of my portfolio should be in bonds. This really depends on your time horizons and on your age. In the long run, over the course of 10 to 20 years, stocks will always outperform bonds. The historical average stock market return over the past 80 years is about 10% a year, whereas the average bond return is only 5%. Also, if you're only looking for annual income, a good blue chip dividend stock will reliably pay you 4 to 6% in dividends every year, whereas a good quality bond will only pay you 2 to 3% in interest every year. In the long run, stocks are the clear winner. But in the short run, bonds are much safer and far less volatile than stocks. In the short term, we're talking between 2 and 3 years, stocks can be very volatile. They can swing up and down and you can't confidently expect to make a profit. Dividends can be cut, losing your source of income, and the value of the stock can plummet, losing your capital gains. But a bond's value rarely swings up and down, and a bond will reliably pay you a fixed amount of interest every single year. So if you are approaching retirement and you can't be taking any chances with your money and you need that consistent income, you should invest heavily in bonds. But if you're a young investor in your 20s, you have 30 to 40 years ahead of you before you retire. So now is the time when you can take those risks and you can weather those storms. And so you should be investing heavily in stocks. If you remember from my last video of stock investing, there has never been a 20-year period in history where the stock market lost money. So if you're in your 20s or 30s, sure, you can play it safe and invest heavily in bonds, and you'll earn a comfortable 4 to 5% rate of return every year, but that's the max you could possibly earn. You'll be missing out on the 10% a year or higher returns that you could have gotten with stocks. The proportion of your stocks and bonds in your portfolio is called your asset allocation. And a good rule of thumb to determine your asset allocation is the 100 rule. It's very simple. Just take the number 100 and subtract your age. And the number you get should be the percentage of your portfolio invested in stocks. Using this rule, if you're 25 years old, you should be investing 75% of your portfolio in stocks and 25% of your portfolio in bonds. The older you get, the more conservative you should invest, and so the more bonds you should buy. And when you're 50 years old, you're probably thinking about retirement in the next 10 to 15 years. And so you need that security and reliability offered by bonds. So using the 100 rule, you should be investing 50% of your portfolio in stocks and 50% of your portfolio in bonds. The 100 rule is a good rule of thumb, but I personally don't follow it. I'm in my 20s, and I currently have about 10% of my portfolio in bonds, the rest is in stocks. If I was using the 100 rule, I should be investing at least 20% of my portfolio in bonds. But while I'm young and I don't have any kids or anyone depending on me, I like to be more aggressive in my investments. Plus, most of my stocks are dividend stocks, which are generally less risky than growth stocks. Plus, I'm getting reliable income through dividends, and so I'm already getting most of the benefits of bonds. As I get older, I will definitely start investing more heavily in bonds, and eventually start to approach the 100 rule. Also, I don't personally own any bonds directly. Sure, you can go out and buy individual bonds from a government or a corporation, but I find that the easiest way to invest in bonds is to buy bond ETFs. ETFs are a collection of stocks or bonds packaged together into one fund. So when I buy a bond ETF, I'm buying a little piece of hundreds of bonds, and I'm collecting the monthly income from all of these bonds. The bond ETFs I like to buy are ZFL and ZEG for Canadian bonds, and SCHZ for US bonds. Another great thing about investing through ETFs is that if you use QUESTRADE, which is my favorite broker, you don't pay any commission when you buy ETFs, whereas other brokers will charge you up to $10 per trade, the same price you pay when you buy stocks. I am a huge fan of ETFs, both for stock investing and for bonds. And next week, I'll make a video just about ETFs and why they're the best way to diversify your portfolio, even more so than mutual funds. So there you have it. That is everything you need to know about bonds. Bonds are a low risk and reliable form of income, making them especially useful as you get older and approach retirement. They're also a great way to protect your portfolio during a recession when the stock markets fall. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. I'll be posting a new video every Thursday. And let me know in the comments below, how much do you invest in stocks versus bonds? Be sure to tune into my next video, where I'll be returning to my credit card series, and I'll be breaking down the top 5 free credit cards with no annual fee for Canadians. Thanks everyone, and I'll see you guys on the next episode of The Canadian in a T-Shirt. Bye guys.